related to industrialization and industrial development. And today, the topic, as you all know, is about drivers of investment in India's manufacturing. And this is very important, particularly today itself. The GDP estimates of July and September has once again been released, and it shows that there is a contraction in manufacturing and mining. And not only this quarter, but we see from 2010 to 2018-19, there is a consistent decline in manufacturing investment, particularly in machinery. So we are going to discuss this, and let me first of all take the privilege of introducing the speakers and very distinguished panelists. We have with us Dr. Zico Dasgupta, who would be speaking on this very important topic, drivers of investment in manufacturing. He is a faculty at Azim Premji University, and he has been consistently working on issues on investment and macroeconomic issues. And this, what he's going to talk is a paper which has recently come in the Journal of Structural Change and Economic Dynamics. At a very early age, he has already published quite a good number of papers in reputed national and international journals. But of course, the discussion would not be limited to this particular paper. So he would be presenting the paper. Ideally, the speaker is given 25 to 30 minutes to present the case. In the panel, we have today three speakers. We have Dr. Rohit Azad, who is a faculty at the Center for Economic Studies and Planning at Jawaharlal Nehru University. He is a macroeconomist, well acclaimed and well published. His book, It's Not Over, Structural Drivers of Global Economic Crisis, is published from Oxford. And he's also a very well-known teacher in JNU of macroeconomics. We have Dr. Jyotirmoy Bhattacharya, who is a faculty of Department of Economics, Ambedkar University, Delhi. Once again, a very well-acclaimed macroeconomist. And if you come across any student of economics in Ambedkar University, Delhi, certainly he or she would be an admirer of Jyotirmoy's lectures in macroeconomics. Now, someone probably has kept. We have with us Dr. Santosh Das, who is a faculty at the Institute for Studies in Industrial Development, mainly focusing on, his research is mainly focused on industrial investment and banking. He has published a couple of papers on industrial finance, mainly focusing on industrial finance. And he has also completed two big projects on banking and industrial finance recently. So we have a very distinguished panel, and we think that it would be a very interesting and fruitful discussion on this very interesting and important topic. So without much ado, I request Dr. Zico to present his case.
Thanks a lot, Professor Satyakiran. And let me open the PowerPoint.
And someone has kept the audio open. Please close that.
Can you see the slides?
Yeah.
All right. So first of all, thanks for having me here. And to start with a bit of apology, there were some issues over here for joining. So let me start the presentation. This is, of course, based on the paper which appeared in the structural change paper. The name of the paper is Investment Function and the Role of Exports. What I would like to do is to present perhaps some of the main results of the paper and the basic intuition of the paper, and try to use it to make some sense about the present juncture of the economy. Some implications which perhaps can be drawn from the basic results or the arguments of this paper. All right. So first, the Indian context of this, that why one is at all interested in thinking about drivers of investment or some topic like investment function or the role of export. So first of all, the role of investment in the Indian context, the manner in which or the role investment has played in the recent period. First of all, few stylized facts about the Indian economy. Typically, the high growth phases in the Indian economy has been associated with typically higher investment rates, high investment GDP ratio, and again, typically low growth phases would be associated with low investment GDP ratios. So for example, the decade of 2000s, the decade of early 90s, a bit of mid 2010s, all these are episodes of high growth period. These are typically also the periods of high investment ratios as well. And similarly, episodes of low growth, which would be typically say late 90s, late 2010s, from 2017 onwards, there has been a persistent economic slowdown even before the COVID period, and that was also associated with low investment ratio. In short, the growth trajectory overall can be described as investment-driven growth process, where investment GDP ratio typically shows a rising trend during high growth phases. The second stylized fact, again, these are very well-known facts, but let me reiterate it in any case, that higher phases of investment are typically have been driven by the corporate sector, and sectorally, typically the manufacturing sector or the registered manufacturing sector in the high growth phases. Now, here comes the question that if it is the case that high growth phases are associated with high investment phases, what exactly demarcates these phases? In other words, what demarcates the high growth, high investment phase from the low growth, low investment phase? In other words, what exactly drives investment? That is the kind of question that we would like to address. And there has been two kinds of answers to this question as far as what has driven investment in the Indian economy. The first, coming from the supply side, has been, I guess somebody is drawing something on the PPT. All right. Okay, so one kind of answer has been through the supply side route. This would be typically by Kaushik Basu and Panagaria has argued in these lines, which is essentially involves the rise in the factor productivity growth rate, which essentially drives the steady state investment rate or growth. Now, typically these frameworks have been based on very rigid kind of assumptions, where there exists one-to-one relationship between productivity growth rate and investment rate. In other words, it really ignores the role of fundamental uncertainty or investment expectations as such, which leads one to explore the second kind of explanations, which is typically the demand side framework, where changes in autonomous components of demand has been used to understand the trend in the investments or growth. One kind of channel through which this autonomous components of demand is expected to affect investment is through the capacity utilization rate. Investment is argued to depend on the existing capacity utilization rate, because firms can typically target a specific level of excess capacity. The moment the aggregate demand rises, the capacity utilization rate rises, firms are forced to expand their capital stock by incurring additional investment expenditures. So any changes in our autonomous components of demand, and what we mean by autonomous components of demand, it can be typically say interest rates, it can be net exports, different kinds of autonomous components of demand has been argued to change capacity utilization rate and hence investments. The second kind of channels can operate or can be argued to induce investment at any given capacity utilization rate through many other channels, say through the liquidity channels and different other channels. But broadly, this can be clubbed together as a route where autonomous components of demand play a role in explaining investment as such. Now, if that is the case, and this is largely the broad framework in which we would try to understand the trends in the investments or the high investment, high growth phases, the question is, what exactly are those autonomous components of demand? What are the drivers of those demand? And when we say this as the autonomous component, what we mean by autonomous, this is autonomous to output as such, in the sense that all those factors which does not necessarily respond to the output variable. Say, for example, when we talk about, say, interest rate, when we talk about the exports, these are typically factors which are somewhat perceived to be exogenous to what's happening to the aggregate output or growth as such. It is perceived to cause growth, not the other way around. In that sense, it is exogenous. All right. Now, broadly, as far as thinking about the autonomous components of demand or the stimulus of investment is concerned, there has been largely three kinds of routes through which the trends in investment broadly has been perceived in the global economy in the recent period. First can be termed as the net export channel. This would be, of course, the China route or the route by South Korea. Typically, these countries would register an improvement in trade balance on net export, which would be argued to positively affect aggregate demand of the present period, hence capacity utilization rate, which in turn would be argued to boost investment, and hence net export and investment is perceived to move in similar direction during that entire period. The second channel can be perceived as the interest rate channel or the credit channel. Typically, the US high growth period just before the global financial crisis has been explained by many through this route, where reduction in interest rate, easy credit, is perceived to boost personal loans, personal borrowings, consumption demand, and hence again increase aggregate demand or capacity utilization rate, and hence again leading to or boosting investment rate as such. The third is, of course, the usual fiscal route, where any additional government expenditures can lead to higher demand or capacity utilization rate, and hence increasing the investment rate. Now, in the Indian context, typically it would be the case that high growth period has been associated with deterioration in the trade balance. For example, during the high growth period of the 2000s, there was a sharp deterioration in the trade balance. Similarly, during the periods of relatively low growth phases, particularly say from 2016-17 onwards, one would also see some recovery of net exports. In other words, net export GDP ratio has not increased during the high growth period. And that is the reason why most of the explanations as far as the growth or investment within the demand side framework has largely focused on the demand side routes or the domestic demand side channels. And there are three channels of domestic demand which has been particularly emphasized upon. First is the interest rate credit channel during the decade of 2000s, that's as argued by Professor Chandrasekhar and Ghosh, Professor Nagaraj, that largely the decade of 2000s was associated with easy inflow of FIIs. Interest rates were reduced, which led to rise in the credit deposit ratios, higher personal loans, consumption demand, with boosting investment again through different channels of equity demand. The second, this is particularly the route which has been explored by recently by Dipankar Basu, a paper which appeared in Metro Economica. This argues that the investment rate in the manufacturing sector increased, particularly in response to higher profit share in the manufacturing sector. And the broad argument is that at any given capacity utilization rate, if the profit share rises, the liquidity of the firms, the ease of accessing liquidity improves. And this increase in the ease of accessing liquidity leads them to incur higher investment rate. And typically the trend in the investment rate in the registered manufacturing sector has been particularly related to similar changes in profit share. So high investment rate during 2000s would be perceived as a logical consequence of higher profit share within registered manufacturing sector during this period. So this is again a second route of thinking about the stimulus of investment through the domestic demand channel. And third, of course, has been the synchronized fiscal stimulus packages, which has been implemented after global, just in the immediate aftermath of global financial crisis, 2019 and 10-11, which would again by similar mechanism would increase capacity utilization rate by increasing demand and hence boost investment. Now, given this broad set of explanations which largely exist, there are three stylized facts which perhaps require additional explanation when one thinks about the trend in the investment. The first is the odd relationship between investment, exports, and net exports. This is the share of investment, exports, and net export in GDP during the liberalization period as a whole. Two stylized facts or two things stand out through this trend. First of all, as you would see, that investments and exports has largely moved in similar direction. Secondly, during periods of high growth, for example, if you see the mid-2000s, which is a period of high growth, these are typically associated with both the rise in the investment GDP ratio as well as a rise in the export GDP ratio. Similarly, a relatively growth slowdown phase, which occurred from 2015-16 onwards, is similarly associated with a reduction in the investment GDP ratio and export GDP ratio. But the second feature is equally important and interesting. That investment and exports has moved in opposite directions as compared to the trend in the net exports. During the period of high investment and high export, net exports has deteriorated, and during periods of low investment and low export, net export has recovered. And this is evidently very distinct from the kind of export-led kind of growth trajectories that one is accustomed of. Say, for example, of China's export-led growth phases, and I'm talking about before mid-2010s particularly, or say the 80s South Korea experience. So the first stylized facts is the odd relationship between investment and exports, despite a deterioration in the net export. The second stylized fact relates to the exogenous character of the exports. The blue line gives us the growth rate of nominal value of India's exports over the period, and the orange line gives us the nominal value of the growth rate of imports of rest of the world. The gray line gives us the trend in the real exchange rate index. The rising trend indicates appreciation. What this trend tells us that firstly, the export growth rate has largely responded to exogenous changes in global demand. What I mean by exogenous changes is not only the change in the level of growth rate, but also the structure of the global demand as well. It would be perhaps, it's quite well known that during mid-2000s, the export structure shifted in favor of typically resource-based commodities like, say, for example, petroleum products and all, in which India would have, a relative kind of an advantage as far as exports are concerned. So both due to changes in the level of export growth rate, exogenous changes, as well as changes in the composition of demand away from high technology goods towards resource-based commodities like petroleum, had an impact on exports despite appreciation in the real exchange rate. All right. So the second stylized fact is about the exogenous character of exports. The third, and this relates to the composition of exports, and this will have a role to play when we think about the stimulus of investment. What we do over here is to distinguish between two kinds of exports. Exports are distinguished between the two groups of countries. The group 2 countries are termed as the high income countries. The high income countries are defined as far as the manner in which the World Bank would define it, the high income and the upper middle income countries. And the relatively low income countries are the group 1 countries where India would appear. This would be the middle income, lower income countries like that. The orange line, the blue line and the gray line respectively shows the export capital ratio of India's registered manufacturing sector in these two destinations. So group 2 export capital ratio and group 1 export capital ratio, the blue lines and the gray lines would give us the trend. The orange line, the export capital ratio for group 2 is the orange line. The blue line is the investment rate in the registered manufacturing sector. What again this tells us is that the investment rate or investment capital ratio in registered manufacturing responded largely as per the trend in the export capital ratio for group 2 countries. Whereas the export capital ratio of the group 1 countries remained largely stagnant or largely remained relatively flat. In other words, if the export if the exports towards the group 2 countries have increased during the similar period, investment rate has also increased, and just the other way around. Okay. Now, given these 3 stylized facts, this is the broad and alternative or a distinct proposition that we would like to examine, both theoretically as well as empirically. That first, that whether export-induced investment and growth process is possible despite a deterioration in the trade balance. This largely follows from the stylized fact 1 and to some extent stylized fact 2, where exogenous changes in export, whether it is the case, it can somehow directly affect investment, even if there is a deterioration in the trade balance. The second is, of course, related to the first one, that then independent, whether it is the case that independent of the direction of change in trade balance, exports can have a positive impact on investment. And why this proposition is important? Because largely based on the direction of change in trade balance, the stimulus for growth are largely divided, distinguished between a domestic demand-led growth trajectory or an export-led growth trajectory. So the proposition is whether an economy can be termed as an export-induced growth trajectory despite a deterioration in the trade balance or not. And in this regard, what we would explore is the possibility of what we term as the structurally biased investment function. And by structurally biased investment function, what we mean is that investment rate responding differently with respect to changes in domestic demand and export. In other words, how much investment rate, perspective of relatively low income countries, firms might require incurring additional investment expenditures if the demand is originating in the export market of high income countries. That's the broad proposition. In other words, the manner in which investment would respond can vary depending on the origin of demand. If it is the case that the demand originates in the domestic economy, the responsiveness of investment can be different as compared to when the demand is being generated in the high income countries. And given the stylized fact 3, where investment capital ratio is responding to the export capital ratio that is directed towards the high income countries, that's the basis of this. That's the basis of this kind of proposition. Please feel free to interrupt or just ask clarificatory question if I'm not being able to clearly articulate the points that I'm trying to make. Okay. Now, some stylized facts and before coming to the broad empirical results. What we do over here, these are the broad scatter plots, thinking about the relationship between 4 variables. The investment capital ratio, which we take as the investment rate, the net value added capital ratio. So these are all at the 2-digit level of the registered manufacturing sector. So I by K of different 2-digit sectors across the liberalization period, that is 92-93 to 2018-19. In the horizontal axis of the first panel is the NVA capital ratio, which is taken as the indicator or the proxy for the capacity utilization rate, assuming that the technological output capital ratio largely remains stable over time. In other words, NVA capital ratio, the trend of it is taken as a proxy for the trend in the capacity utilization rate. The second, the right-hand side panel is the relationship between investment rate and the rest of the world import capital ratio. So here the numerator in the horizontal axis is the rest of the world imports, which is exogenously given, and one is deflating everything by the capital stock of those 2-digit sectors. In the southwest panel, we have the investment rate in the vertical axis and the export capital ratio in the horizontal axis, again for the 2-digit level. The right-hand side in the bottom row is the relationship between investment rate and profit share. Why do we include this scatter plot? You can think of this to examining the proposition of what Dipankar Basu made in the Macroeconomica paper, where there exists a positive relationship between profit share and investment rate. What would be evident from this broad scatter plots that there seem to appear some kind of positive relationship between investment rate and the indicator for capacity utilization rate, which is row 1, column 1 panel. The other panels, the relationship between investment rate and the rest of the world, which is an indicator of global demand, also seem to have some positive relationship. Similarly, there seem to have some relationship between investment rate and the export capital ratio. And yet, the relationship between investment rate and profit share, that doesn't appear to have much kind of a significant relationship. It appears to be flat as far as the scatter plot is concerned. What we want to do is to estimate the following kind of an investment function.
One second, sorry.
Yeah.
Will you be able to complete, say, within 5-7 minutes?
I will. Yeah.
Okay. Thank you.
Okay, so let me just put the results very briefly. So since I have 5 minutes, let me put the basic results and the basic intuition across. What this empirical result shows us, we want to estimate primarily investment function 1. Investment function 2 is basically just notation terms. So one can simply concentrate on the first investment equation. The GI to the left-hand side is the investment rate at the 2-digit level. In the right-hand side, we have the lagged value of the investment rates. CU is the capacity utilization rate of each sector across period. The export ratio is the export capital ratio across 2-digit sectors. In some specifications, we will also check the indicator for global demand. In other words, instead of export capital ratio, in some specification, we will also check the effect of the rest of the world import capital ratio on investment rate, and the rest are the time effects and the sector level fixed effects. What this table tells us are the 2 things. First of all, after controlling for capacity utilization rate, export capital ratio, as well as the indicator for global demand, has a positive impact on investment. What it tells us that at any given level of domestic demand or capacity utilization rate, exports have a positive impact on investment rate. If you look at specification 3, we further want to examine that whether after controlling for capacity utilization rate, after controlling the effect of exports, whether profit share has an additional role to play in determining the trend in the investment. You would see that that it is statistically insignificant. In other words, the trend in the investment rate can broadly be explained in terms of the exogenous changes in global demand or exports as such. I will not have the time to go through the model, but the broad idea, let me just tell you in any case, that why is it the case that despite deterioration in trade balance, one is being able to argue for a positive stimulus, a positive effect of exports on investment. The argument is the following, that a rise in exports have two opposite kinds of impact on net export. The first impact is a positive impact, that since net export is the difference between export and import, rise in export improves net export. The second channel is that because export has positive impact on investment and growth, it also increases the import demand as well at any given import propensity, because both growth, capacity utilization rate and investment rises on account of higher export. So what happens to the net export is a culmination of two opposite kind of effects of exports on net exports. The argument is that in India's case, higher export has positive impact on investment rate, but a negative impact on net export because of the channel through which it affects investment and growth. All right. Do I have 2 minutes? Just a broad implication. So this is broadly about the paper as such. I think this is the gist of the paper, but just some broad implication as far as the present juncture is concerned. The present juncture has been characterized, if you remember, that from 2017 Q4 onwards, India has been experiencing the most prolonged economic slowdown since the 90s onwards. Even if one excludes the COVID period. So the pre-COVID slowdown was one of the most prolonged periods of economic slowdown in the Indian economy. The COVID shock has, of course, increased that challenge. The question is that right now the global demand is weak. Fiscal stimulus packages are gone. One is trying to get back to the initial target of the fiscal deficit GDP ratio. The only mechanism which could have perhaps the only mechanism that exists right now is perhaps the interest rate channel, which in any case is rising right now in the midst of higher inflation rate and the increasing Fed rate. But suppose interest rate does is reduced somewhere in the future, can it compensate for the weak global demand in itself? Just 2 slides on that. The relationship between interest rate and credit deposit ratio, because remember, credit did play an important role during the 2000s. This graph shows the relationship between the weighted average lending rate, which are the red lines and the green lines, depending on which 2 series one is talking about. These are the weighted average lending rate of commercial banks. And the blue line is the credit deposit ratio. We have categorized the trend in the credit deposit ratio, distinguished in terms of different structural breaks as per the Bikeren methods. As you would see that during the 2000s, there was largely a negative relationship between the credit deposit ratio and the interest rate. Interest rate going down, credit deposit ratio going up. During the decade of 2000s, despite a decline in the weighted average lending rate, reduction in interest rate, credit deposit ratio has not responded. And the reason is, and this is, of course, the relationship between the GDP growth rate and the interest rate, that despite a decline in the weighted average lending rate in the recent period, there has not been any much recovery as far as the growth is concerned. And the reason is that the credit growth rate over the period has largely responded to the changes in the export growth rate in the first place. The blue line is the nominal growth rate of credit, year on year credit growth rate from 90s onwards. And the orange line is the nominal export growth rate. As you would see that except for the period of demonetization, which is the 2016-17 period, largely the credit growth rate has responded to the changes in the export growth rate. And because the export demand has been weak in the recent period, it's hardly surprising that the credit demand has also been weak. Reduction in the interest rate has not been able to compensate either to, in terms of boosting credit demand or boosting growth as such. This basically points out towards some kind of dependence on the external sectors to maintain high growth. And the domestic policy instrument of interest rate or monetary policy is not being sufficient to compensate for the weak global demand. What this perhaps point towards is thinking about alternative policy frameworks which can accommodate additional government expenditures. I'll stop over here. Thanks.
Thank you, Zico. Very insightful presentation, and hope it will provoke a lot of issues and discussions. So first, I will request Dr. Rohit to comment on this presentation.
So you said, Shatukida, 10 minutes max.
10, 12. No, not max. Don't be.
No, I mean, Zico and I have been interacting on multiple occasions, and we've also worked together on one of these papers. So my question may be repetitive, Zico, and apologies for that. It's very interesting work, particularly because it questions the idea of export-led growth only seen through a trade surplus rather than an export-led growth, even with a trade deficit. So that I think is very interesting, and that this paper shows quite well. This is also an argument Professor Patnaik also had made. So it's very good to see it both in theoretical form as well as empirically very well done. I just have a few comments and a few questions to use. Some of them may be repetitive, Zico, but still for the audience, maybe even though we have discussed it, maybe for the audience it may give some clarification. So two clarificatory things which I would first ask and then go to a couple of more relatively more substantial ones. And number one is when you showed the two group countries, group 1 and group 2, group 1 was basically the low income, relatively low income countries, right? And there you showed that the investment capital ratio of India has followed more or less the pattern of the exports to the first world or whatever group 2 countries. Now, is it because of the fact that group 1 countries during this phase did not have a high growth? So, you can have a situation where group 2 countries influenced your investment, but not because they were more capital intensive necessarily. The exports to these countries only were more capital intensive. It could very well be, I don't know, I'm just asking, that group 1 countries in this phase were actually not growing. So whether it is capital intensive or not, or the kind of products you sell to these countries, that could be a reason, irrespective of capital intensity, that could induce a low response on investment. That is not to say that group 2 countries exports to these countries did not matter. I'm merely asking the distinction between the two. The other is the long-standing debate on profit-led growth. And the fourth chart that you had shown, which essentially questions the profit-led growth channel. Now, my question would be that if that is the relationship, which is pretty much flat, and your empirical results also show that the coefficient is not distinguishable from 0 effectively, because they're not significant. In which case, how did Dipankar Basu's results come through? Because, irrespective of the other variables, this is a scatter plot of 2 variables, right? This is not of the residual. This is not after doing the regression. This is of individual. I'm assuming that's the case, right? This is the relationship between 2 variables. Now, if the relationship between 2 variables comes out to be in the scatter plot as Professor Chandan Mukherjee had said, that if something is not visible to the naked eye, whatever you do then would be massaging the data to produce a result. So my question would be, if it's a flat relationship, then where does the profit-led growth argument come from in the other paper? So these are clarificatory questions. My relatively more, let's say theoretical discussion on this is the argument that you're presenting essentially gives the impression that India primarily was dealing with merely a demand constraint economy. That is not to say, of course, demand constraint was an important component, but could it not be that we were dealing, or a developing country deals with multiple constraints? The other constraint being finance or credit constraint. The fact that you have had an NPA crisis resulting from exactly the phase of high growth, putting all the eggs in the demand constraint basket gives the impression as if credit did not play a role. I'm not merely saying as not a leading factor. So in the sense you can say that investment increase and credit increase. Yes, of course, that would happen. But can it not be that you have, in the old Keynesian argument that both the state of confidence and state of credit matter? So state of confidence can come from exports or domestic market. In this case, you're saying export markets, but both are necessary for revival. So one of it can bring it down, but without a revival in both, you would not be able to revive the economy. So can it not be a story which is a combination of the two factors? So the role that credit may have and did play an important role, in my opinion, and in our work, which reflects in the NPA, somehow is kind of underplayed in this. Was that deliberate, or it's something that you feel is merely a follower to investment? In which case, the argument that you would be making, the Minskian story, by and large, then doesn't fit this whole thing. In which case, how does one explain the NPA crisis in this episode? If it is primarily demand-driven only, then credit followed, and it's fine. Then why should that lead to the crisis that we have been facing for very long? And following from that, the last part that you showed to give a critique of this possibility is when you show that the exports have gone down and the credit has essentially followed that. And hence, again, the driver essentially is export. Credit is more a follower of that whole, the lead causality or whatever you want to say, essentially comes for there. But I could argue, at least on credit, differently, that it's exactly the time where both the domestic and the export markets collapsed. One, because of demonetization and the GST and the unorganized sector. The one was the NPA crisis, which made the credit expansion itself difficult. The banks themselves became wary of giving credit. But additionally, not only was there a global crisis of demand, there was also a domestic demand crisis imposed by all the stupid macroeconomic experiments that were done on India. So distinguishing between the two, one could have argued if the domestic demand had not gone down and yet credit had not pulled up, then one could say credit channel it's primarily just demand. But putting it completely as if credit follows, maybe perhaps I think is perhaps underplayed. So these are the comments I have.
Thank you, Rohit. Now I request Dr. Jyotirmoy to.
I hope I can be heard.
Yes.
Okay, so first of all, thank you, Shatrugita, and thanks to ISIT for giving me a chance to discuss this very interesting paper by Zico. Can I just have some slides? Can I just share them?
Please.
So my comments are mostly on the paper rather than on the presentation. So I guess there are many newer things in the presentation. But I will like to speak on what I got from the paper. So the paper is asking that, In terms of macro, what Zico is asking is that does exports have any impact on macroeconomy other than its impact to aggregate demand? The net exports component we all know about. So Zico is saying that if there is no effect on trade balance, does exports still matter? And particularly, he's asking that does it affect through the investment function? And I had to revise my Kalishkian macro, so maybe others are in the same boat as me. So Rohit and Zico, please point out if I'm making a blunder. But the basic structure of the model, because Zico's model, of course, has many components because actual model which is being taken to data. But in terms of the broad skeleton, you have something like this: delta k by k is a growth rate, and you have the investment delta k by y, savings ratio also same thing, y by k dash. So k dash is the actual capital utilized. So and then you have k dash by k. So investment rate into output capital ratio into capacity utilization. And this investment rate is a function of your capacity utilization, profit share pie, and export. So which is where the Zico is putting the question that does export independently play a role apart from capacity utilization? And that's equal to savings, which itself is a function of profit share because the standard Kalishkian assumption that capitalists and workers have different savings rate, and then net exports also play a role. And in this model, then you solve for U to figure out what is the steady state capacity utilization. The question is that will X matter? And if X matters, what will happen to the equilibrium? And as Zico mentioned in today's presentation also, the mechanisms are that the investments are required to open up markets and foreign markets may require sophisticated goods, so higher investment is required. So the first point I would like to discuss is the link from these mechanisms to the particular kind of investment functions assumed. Because in both case, I buy both the mechanisms, but my question is that will they lead to the particular kind of investment function which is being posited by the model? Because when you think of investment to open up markets, then one would think that then that investment would be a function of change in exports, right? If I'm already exporting to a market, I have, so to speak, already opened up the market. So I don't need to invest any more to kind of just get market access. So if I'm increasing my amount of exports, then I may have to make some more investment to create more assets. But if I'm exporting the same amount to the same places forever, then that kind of investment should not be required. Second is that you're saying that foreign markets may require more sophisticated goods. But then again, my question is that why should that impact investments? Because say foreign markets require more sophisticated goods, I may say that okay, that requires more capital. So in that sector, the output capital ratio may be lower because I have to have more capital intensive production to serve that market. But why should I necessarily have to invest more as a function of the capital I have? Because your investment G is I by K, investment is a share of capital. So maybe that I require to have more capital intensive production to serve that market. But as a function of the base capital, why should I year after year invest more just because my goods are more sophisticated? So while both these mechanisms seems very plausible, I would like to understand more that how they lead to the particular investment function you're assuming. And I would also like, since it's a kind of open discussion, so this is not really about Zico's paper, but about the whole framework of all this investment function, where you have a capacity utilization component. Because as Zico said that the story behind that, at least the idea is that you have a target level of capacity utilization for whatever reason. And you have maybe some kind of inertial expectation. So you say, okay, today's output is likely to be tomorrow's. So if my capacity utilization is more than the target, I should invest more to build up more capacity and vice versa. But if that is the story for capacity utilization, then the question is that how do you reconcile that with multiple steady states with various capacity utilization, right? Because then when you solve for the steady state, the capacity utilization you get will depend on the values of various exogenous parameters. Like in Zico's case, it depends on X. So now if I get a steady state capacity utilization, which is different from my target, right? Because it will be equal to my target only by coincidence. So if it is different from my target, then how can that state remain steady? Why won't the firms, even in the long run, not try to do something to reach their desired level? So if you say that capacity utilization enters because of a desired level, then how do you reconcile that with solving for a steady state where the steady state level is not the desired level? Why wouldn't people try to do something about it? And then the question of why should domestic and foreign demand, which is the central question of the paper. And there I was wondering, because at some point you also take it to the data, that could it be, can we kind of figure it out by saying that it is some kind of heterogeneity in the sector? Because in a two-digit industry actually includes a whole variety of production process and so on. So could it be that we can say that even one good has heterogeneous varieties, one variety for the domestic market, one variety for the outside market, and your statistical measures of output and capacity and so on don't capture the heterogeneity well. So even though at a theoretical level, the foreign good may not require more investment and so on, maybe because of the mismeasurement, something is happening, and therefore it appears as if it has more investment. I don't know whether such a story can work out, but that could be one answer to how we reconcile the idea that exports should require more investment. But I think the whole issue of why there should be a capacity argument in the investment function itself, of course, there's a long tradition of that which Zico also builds upon. But I think that needs to be still examined from first principles. And coming to the data, it's a panel data, the industry and time effects. One issue which is recognized as capacity utilization, we don't directly recognize. So Zico has to assume that output capacity ratio has not changed, which is something that we need to really think about, because it is a very long period from 90s and onwards. So to assume that for such a long period, output capacity ratio has not changed, which has been a period of dynamic for the economy and for the world economy, is also something that one needs to think about. But he gets significant result. I have kind of suggestion that I think panel data with fixed effects is actually kind of underselling yourself. Because one is that suppose you have different industries with different level of participation in exports, then if you put industry fixed effects, then their average level of investment anyway is eaten up by the industry fixed effect. So even if this industries on an average are investing more, right? So maybe whatever our discussion about mechanisms, but suppose there's a mechanism, but that will all be captured by the industry fixed effects. It will also be interesting to look at the value of this fixed effects against the export intensity of the industries. That even at the level of distributed stresses, is it the case that more export intensive industries actually have a higher investment ratio? Because if you put in fixed effects, then that will be kind of eaten up by that, and we will not observe it at all. And secondly, I would feel that, one way that opening up the economy and more participation in exports would change your macroeconomic condition is by changing the composition of output. That your export sectors expand, other sectors contract. So if you do a kind of industry level kind of panel data, then you're not capturing this compositional change. So again, say that for whatever reason your investment, your export intensive sectors are also investment intensive, then one thing which would happen is that they would expand, and that would lead to more investment in the economy. So how do we capture that empirical? That as the economy becomes more open, you actually see a change in the industrial composition. Also, there is a lot of work nowadays on within an industry change in the share of output of different firms. At larger, more export intensive firms grow, and what happens there. And finally, I would like to reiterate the question, or rather theme. Rohit asked it in different contexts of supply side or the demand side. But my question is the same, that all the export-led growth stories, the big story is actually about productivity. That there's a story. When I'm calling it a story, precisely because I'm not insisting that there's an empirical basis. That ultimately, if you export, then there are knowledge spillovers, technology transfer, and productivity grows. But that part is not kind of given a place at all. And is there any way to rule that out, and so on, and have you thought about it? So I would stop here, but once again, let me say, a very interesting and a very important paper. Thank you very much.
Thank you, Jyotirmoy. And now I request Dr. Santosh Das to share his comments and observations.
Yeah, Satyakita, am I audible? Yeah. So thank you, and I must congratulate Dr. Zico for publishing this paper in a highly reputed heterodox journal. So I'll begin with basically the results with your result, which suggests so there is a significant, statistically significant relationship between exports and investment. And what you after going through your paper and presentation, it suggests, you have elaborated it in detail, that how does export translates into sort of investment growth is through the argument that there are product differences, and any country, even if India is a developing country or developing countries, since the demands are different, there are differences in the demand, like the domestic demand and export demand or foreign demand varies. So the countries would try to sort of address the sort of try to address the export demand, external demand, and that is how their production structure will be upgraded. Now the question is, if that is true, now the question is it true in case of India? Because the data that we have used is about the Indian manufacturing sector. If you look at some of the recent studies, recent studies explaining what has happened to product diversification, for instance, what has happened to, whether the export of destination country has changed or not. So I'll just quote few study, which is a recent study, and it was presented here also, and it's our one of our working paper. It's by Aradhana Agrawal. So it suggests it's true that in recent years, so like if you look at the sort of product diversification has happened in recent years, and India is moving towards more of sort of medium and high tech, sort of exporting low high and medium tech technology induced products. But the point is, this is a very recent phenomenon. This has just started happening. And another sort of point is, if you look at the Donny Rodriguez, this production complexity sort of index, or what they prepared at Harvard, explaining sort of which are the countries those are exporting more complex products, technologically more complex products. And there you will find, I mean, they have also have commented about India. It suggests first, one of the major finding is, as of now, mostly countries, those who are exporting sort of complex products are advanced capitalist economies. Number two, if you're talking about India, it's true, India is up in the ladder in terms of, exporting complex complex products, but still it's a beginning. So there has not been significant structural shift, you can say, in the production structure, the export structure also. So that is one. The other part is, in the same paper, it suggests that while this is happening, India is moving towards a more sort of, medium tech and high tech, sort of export, induced export. What is happening is India has started losing also on the traditional sectors, traditional export sectors. So what I'm saying is, to hold these arguments to be true, that export would lead to investment growth, then what has to happen is this transition. Like, we are still in a transition, and the data that you have sort of taken, or is there in the paper, in terms of, the period that has been taken for estimation is from 1992 to 1992 till 1918. So it's a 16 years sort of, data. So the point is, this sophistication has started happening, and there has not been significant shift in terms of production structure. So then the question arises whether the whole, this is true, because the estimation is definitely showing a positive relationship. Then whether this analysis or this sort of explanation adds up to or explains that result fully, given that we have just started moving to medium tech and high tech exports. Now then I come to my second point, which is about the issue of causality. So what appears from the paper appears, I'm not saying you have explicitly, or the paper explicitly mentions this, the causality should run from export to investment, but it appears it runs. So that is what gives an impression. But again, in the paper also it's explained. I must say, you have also elaborated how when a country's production structure sort of shifts from low tech to high tech, complex products, then it requires massive investment. And that investment require. So basically, the point is then whether the cycle should begin from investment to export, or sort of export to investment. So that is something probably is something, because see, the basis of the basis of sort of raising this question is, if you look at some of the cross-country studies which came up in recent years, and they have tried to explain what the differences in export behavior of this country, especially low-income countries or less developing economies. And what they've used is, most of the studies have concluded, is because of the differences in the investment, because that has affected their production structure. So it's because of the given investment which has affected their production structure, that has led to a certain amount, that has actually led to a particular type of export regime. So in that context, it's important to look at the causality. And coming to my third point, which I think Dr. Rohit has already mentioned, it's about the issue of profit shares channel. Because if you look at the case of India, not only now, but I mean, there are numerous studies explaining since, in particularly since liberalization, we'll find there is a distinguished pattern between the advanced economies and and low income countries, including India, when it comes to whether how to use profit. So one of the major assumption is stated here is basically, the retained profit will go for reinvestment. Usually that is the understanding, and that is financing constraint. But if you look at the behavior of low income countries, that is not true, and including India. Even today, I mean, throughout the liberalization period, you will find Indian corporates largely tend to borrow, basically, and the sources of borrowings, there is also a pattern, but largely they tend to sort of rely on external sources rather than on retained profit for expansion or for investment purposes. And that is also quite reflected that your result, it doesn't show any sort of significant relationship. And when you explain, and largely then it suggests it's work through credit channel, which also you have showed it in at a later stage, showing how the exports and credit, they are closely related. Because the point is, so that is one, and this might be true for the advanced economies, where largely the preference of sort of the financing preference of the corporates in advanced economies is largely is internal retained profit is used for investment, and if it's required, then they go for borrowings. But if you look at the pattern of pattern of investment in India, the Indian corporates initially, first, they tend to rely more on external sources. B, the initial years of liberalization, I think between 1991 and 1996, you will find they more relied on equity finance, because the cost of equity finance was quite low during that time because of the IPOs. Many firms started issuing IPOs, and suddenly it shifted towards end of 90s until now. So it's more of sort of loans from the banks and financial institutions. And another another explanation or another contradiction that that explains this profit share, why it cannot probably explain investment growth in India, is in recent years in India also, like the Western advanced economies, the Indian non-financial corporates, they have also started investing or acquiring more and more financial assets. I think one of your paper with also Sunanda Sen explains the same. So what has happened is, like their Western counterparts, like in the US, started happening in the 70s, 80s, and in India also over the last 2 decades, most of the companies who are also into manufacturing, they've started acquiring more and more of financial assets. So then if you combine these two, then it doesn't explain this profit share argument. Now coming to my last point, which is about the issue of domestic demand. Because why I'm saying so, see, the point is, theoretically, maybe we can perhaps distinguish between domestic demand and export demand. But when it comes to producers, there is not a dedicated producer for export demand, for external demand to export, basically. So it's, in many cases, mostly will find is the same producer who is also catering to the domestic demand and also exporting. Now the question is, then which one? What I'm saying is, can we really cannot take this domestic component into consideration? Because when the company starts producing any sort of production facility, when then start operating, so since they also cater to domestic market, so when they start operating, they also take that into consideration. It's not only external demand, though there are product differentiation. So one company can have different products, set of products, to sell in the domestic market and to sell in the foreign market. So thank you. So these are some of the things.
Thank you. So we had a very interesting discussion so far. So first I would request, because there are a lot of questions and Zico has to respond to them, and then we will move for further questions from the participants. So first I would request Zico to respond if he likes to, and what are the questions you take up.
First of all, thanks a lot to Rohit, Jyotirmoy, Santosh for excellent comments and questions. That was great and exciting. So let me first start with broadly the three set of questions asked by Rohita. The first about the relationship between exports to the group 2 countries and the one-to-one relationship as far as the composition of the capital intensity of the exports. So yes, so one graph which I couldn't perhaps include in the presentation, it's there in the paper, that during the same time in which the export capital ratio directed towards the group 2 countries are going up, these are also the periods in which the share of high and medium technology kind of commodities in total exports are also going up. In other words, the composition and the trend in the group 2 countries exports largely move in the similar direction. Sorry, I'm just making a reference to another question which was raised by Jyotir Moeda, because this is related to this. I'll come to Jyotir Moeda's question separately later, but on this specific question about to what extent we can control for the effects of technological sophistication as far as the empirical exercise is concerned. Yes, true. Let me also put forward the constraint while estimating these exercises. Now, typically the index of technological sophistication would be primarily, say, for example, Lal's technological classification is in terms of, say, SIC good commodities. It is not always possible to convert it into 2-digit ISIC factors. So because of that, it is difficult to get, say, sector-specific indicators of technological sophistication, because when one is doing the ASI data, one is talking about that ISIC 2-digit. Technological classifications which is available at the 2 digits is not really capture the capital intensity part which I am trying to indicate. So that was one constant. Ideally, it should be there. So I'll think about what are the ways in which one can perhaps indicate, take into account even in this empirical exercise. I couldn't think of one. I tried to. I couldn't think of one while writing the paper. Because of this concordance problem. The profit-led growth and the question of profit share, something related to Santosh's point as well. I absolutely agree that I'm absolutely convinced that profit share doesn't play any such significant role as far as boosting investment is concerned. The point of including profit share in the investment function is to engage with the contesting kind of explanations as far as investment is concerned, as per Dipankar Vasu's paper. Now, coming to why Rohita's question, that why would that paper would have statistically significant results, I'm sure perhaps Dipankar would be the best person to answer that. I'm not in a position to answer that, but my speculation is the following: that there are two differences, primarily two differences with Dipankar Das paper as far as this paper is concerned. One is the time frame. Dipankar Das paper, I think, largely ends at around 2008-9 or 9-10, if I remember. So it broadly captures that high growth phase, that specific phase of the 2000s. Whereas in this paper, it goes all the way to 2018-19. So it starts from 92-93, goes to 2018-19 in my paper. In Dipankar Das paper, it is somewhere around mid-80s or 80s and ending at the 2008-9. So I don't know whether that specific period had some role to play as far as the positive and the statistical, significant relationship which Dipankar had. I don't know. I haven't checked for that time period only. But if one takes into account for the entire period, 26 or 27 years of right from 1992, of course, that such statistically significant relationship disappears. The second, I think, is of course the role of exports. So Dipankar Das paper does not take into account or control for the effect of exports. This paper does. I can see only the differences as far as the methodology, but I won't be able to say that why that paper had a positive, statistically significant result as far as profit share is concerned. Hope that answers the question. All right. The third, the combination of multiple constraints. I completely agree, but perhaps the emphasis on exports perhaps diluted or distracted that point. If one thinks about the growth rate of credit or demand, or one measures that in the vertical axis and say an interest rate in the horizontal axis, think about an IS curve. My argument is not that the Indian economy has registered a vertical IS curve, or that interest rate does not play any role as such, or the credit channel cannot play any additional role as such. My argument is that if one is thinking, say, in terms of an IS curve in the growth interest rate space, there are two effects that is simultaneously happening. One, there is a leftward shift of the curve because of the weak global demand. One is trying to reduce interest rate, but there exists some downward rigidity in the interest rate as well, either because of the currency risk premium that exists in the Indian economy, or because of the rising spread or the rising risk premium in the private sector banks. It would be observed that particularly since 2016-17 and before the emergence of the COVID period, despite reduction in the short-term interest rate and the repo rate, the lending rate of the private sector banks registered a rise. So that also posed an additional constraint in the extent to which interest rate could be declined. In other words, there is a leftward shift of the IS, somewhat downward rigidity in the interest rate, by which, despite a reduction in the interest rate, there has not been much improvement in the credit channel. That would be largely my argument. So for example, the NPS can have ceteris paribus have a positive impact on demand or investment through the interest rate channel, because the effective interest rate would be affected. The argument, what I tried to suggest, that it was not enough to compensate for the adverse impact of exports in the recent period. So to agree with Rohit Das' proposition that both effects perhaps are at play, the emphasis on exports is on two counts. First, that has been the common feature which is present both during the high growth phase as well as the low growth phase. So its absence or presence makes a difference. In that context, it was highlighted. And second, the fact that the credit interest rate channel is not being able to compensate for the adverse impact of exports. So yeah, so it was in that context where I was trying to argue the role of the export, not to deny any ceteris paribus relationship or effect of interest rate. Does that make sense? Right? Okay. Okay. So coming back to Jyotirmoy's set of questions, whether the stimulus would be the change in the exports or the level of export capital ratio. Now, so the way I was trying to understand this is in the following way: that capacity utilization rate, if one is simply thinking in terms of Y by Y star, and one is thinking in terms of, say, the ratio between Y by K. This can be decomposed into two components, say the C parts, the I parts, minus the M part, that is the import part, and the export part. So any post-Keynesian analysis which argues that investment rate is positively related to capacity utilization rate is essentially arguing that the responsiveness of investment to both these components are one and the same. What I was thinking was that what if the two are different? Just like Bhaduri Marglin was trying to decompose the effect of profit rate into capacity utilization rate and profit share, this can be perceived as an attempt to decompose the domestic component of capacity utilization rate to export. Now, I agree with this, that I think a distinction can be made perhaps on the theoretical exercise and the empirical exercise. The theoretical exercise is a broader framework where any difference in the responsiveness will do. It is not dependent on the assumption that the export responsiveness has to be necessarily greater than the domestic demand kind of a responsiveness. Because what we are trying to do in estimating the investment function is that the fact that capacity utilization rate and exports are treated as two different variables is coming from those different responsiveness. So it is not required that the export channel must have a greater role. In the Indian context, so one specific, given the stylized facts of changes in the both the composition of export during 2002-03, as well as the foreign countries' exports. So that was one plausible explanation to that mechanism that one was trying to explore. But broadly for the theoretical framework, I think, as you were saying, that a broad heterogeneity kind of approach perhaps describes the analytical framework, the theoretical framework more than the empirical exercise, perhaps. On the question of the on the assumption of the capacity, the output capital ratio remaining largely the same, the two things. So now NVA by K, of course, it is taken as a proxy for U, the capacity utilization rate. But even if we think of, say, that as an indicator of U beta, the product of capacity utilization rate and technological output capital ratio, I thought the essential result would remain the same, because one is trying to understand whether one, if by controlling the effect of beta and U, one has a separate impact of exports on investment or not. Because that was the essential, the objective of doing that exercise. But for that specific question of beta, of course, a separate HP filter needs to be perhaps, in estimating some potential output, and then separately finding the role of Y star by K would of course help. But I didn't use it because it seemed that it won't affect the result as such. Now, the export intensity factor for 2-digit, I tried to address. Now the productivity question. My proposition is not that productivity cannot have any role whatsoever in affecting investment rate. But where I would disagree is that there would be necessarily a one-to-one relationship, as kind of a solo kind of a route. But for the two channels which I had in mind, where productivity growth rate perhaps can play a role, is one through the profit share channel, the income distribution channel, and the other through the real exchange rate channel. Now, because in the stylized facts, these didn't seem to have much impact, I didn't emphasize on the productivity channel much in the paper. So that was the broad idea. I hope that sort of addresses the questions. In case it doesn't, please let me know. So coming back to Santosh's point of diversification starting pretty late, I completely agree. So broadly over here, the export depends on two analytically distinct set of factors. One, the changes in the growth rate of demand as such at any given composition of exports, and second, the composition of export at a given level of growth rate of global demand. The argument has been in this case that both these factors have a role to play in affecting export and hence investment. So for example, the specificity of 2002-03 onwards, one important factor is the level of growth rate itself, independent of what is happening to the export composition. Now, second, coming back to the export composition, it is true that there has been many limitations as far as the composition of exports are concerned, particularly if one is comparing with, say, China and all. But nonetheless, it would seem that there has been some change in favor of the high and the medium, starting from that high growth phase onwards as well, which will have an analytically distinct role to play over and above the growth rate of global demand. What plays the key role over here is the level of both the level of growth rate of global demand as well as the composition part as such. But of course, there is a limitation as far as the diversification is concerned. Endogeneity in exports. So two things. First of all, in the empirical exercise, export capital ratio is treated as an endogenous variable as far as the explanation variable is concerned. Now, as far as the modeling is concerned, the emphasis was on the exogenous component because of the fact limitation of the domestic policies in affecting export to the extent that was observed in the East Asian countries. Because unlike, say, for example, in contrast to the experience of South Korea or China, where industrial policies or specific domestic policies would play a role in changing both the export composition as well as boosting exports, since that was not very relevant or that was not very evident as far as India is concerned, and exports responding more or less to exogenous factors, that was what the model tried to capture. And in the empirical exercises, of course, one takes into account the possibility of a two-way relationship where both exports affect investment and investment can, of course, affect exports as well. One can also include it in the model, but it would only make the model more realistic but more complicated. So we sort of kept away from that. And the distinction between domestic and exports. So it broadly relates to the heterogeneity of different sectors. So because one is not, when one is estimating this investment function, we are estimating the sectoral data. We are not estimating the firm level data as such. So if the composition of production differs across firms, so each sector, those composition would vary as far as the ratio, both the ratio between domestic and the export component, as well as the composition of export component as well. So it is this export, it is this sector specificity that, that empirical exercises is rather tried to, capture. Yeah, so I hope I've been able to address largely the questions. If it doesn't, please let me know. I'll try.
I think you have responded to all the questions. There were a lot of questions and you have also responded in detail. I would now request, if anyone here we see in the chat box, I would request Dr. Krishna Kumar, why don't you open your mic and audio and just raise the question.
Sir, I think he left.
Okay. So, and then this is Isha, Dr. Isha Chawla. She has a small suggestion. If you could only take domestic value added in gross exports, that is exclude foreign value added, while especially as it varies a lot at the two-digit level. So basically arguing that if you can exclude the foreign value added component while estimating the demand. So any other questions?
Satyagita, can I ask one? I'm
please,
sure
please,
speaking.
Please.
Yeah, first of all, congratulations, Zico, for your publication. Very interesting paper. I was wondering that, because of paucity of time, you had to skip one slide of your theoretical model. If you can briefly discuss about that.
Okay. So, Chair, do I have time?
You have.
Okay.
But completed it within 5 minutes at least.
Now you are posing more constraints.
Chair both liberal hai or simultaneously constraint bhi set kar.
No, but this is a second order presentation. What has not been presented is being asked to present now. So there should be constraints.
Sir, just a moment. Okay. So let me try to do this within the constraints set of the 5 minutes. Let me try to think in terms of the diagrams. So in the top panel, we are measuring the I by K, the G, and this one, the sigma variable captures everything else. That is the S by K plus M by K minus X by K. Now, because both savings and import responds positively to the capacity utilization rate, which we are measuring in the horizontal axis of the top panel, the sigma naught line captures the positive relationship between capacity utilization rate and the sum of that S by K plus M by K minus export capital ratio. The G naught is the investment function. The investment function depends on, again, positively related to capacity utilization rate and some intercept term, which is the exports, and some other autonomous components again. The fact that the investment curve is flatter than the savings function or the sigma function this is basically the Keynesian stability condition. So suppose the equilibrium is at E naught. Any change in exports, now if you can think of the first panel, any change in exports makes two kinds of effects on this diagram. First, the savings line, the sigma line, shifts rightward. That is basically because it has the export capital ratio component in that. So it's a rightward shift of the curve that you get. And the investment function now also comprises of that export element. So because of higher export capital ratio, the investment rate also goes up. So capacity utilization rate and investment rate over here goes up on two counts. First, because of the direct effect of exports, and second, because of the indirect effect on investment. So that is why the equilibrium changes from G0 to G1. The bottom panel, essentially, in the vertical axis, the N captures the net export capital ratio. The horizontal axis captures the capacity utilization rate. Now, because net export capital ratio is the difference between export capital ratio and import capital ratio, higher capacity utilization rate, ceteris paribus, will have an adverse impact on net export capital ratio. That's why the curve is downward sloping. Now, any change in export capital ratio, if you see, will have two kinds of impacts. One, there is a rightward shift of the curve. So the net export capital ratio shifts rightward, that curve. But we also move along the curve because of higher output or capacity utilization rate. In other words, higher exports is having two kinds of opposite impact on net export. One, it has a positive impact through the export channel. It has a negative impact through the output channel. Because in the structurally biased investment function, there is an additional effect of investment. So the growth impact or the output impact of export is even higher over here. And that's why we get an ambiguous effect on net export. That depending on whether the shift force dominates or the movement along the curve dominates, one would either have an improvement in trade balance, an unchanged trade balance, or a deterioration in trade balance. I hope I have maintained tried to maintain both the objectives. 5 minutes.
Thank you. Thank you so much.
Thanks.
Sir, unmute, please.
So any more questions or comments or observations on the presentation and also on the discussion that happened?
Tugida, can we have a discussion on points that Jyotirmoy raised?
Of course, but I think
time constraint.
No. See, one is that I think Dr. Jyotirmoy, he has left, so we can have a discussion.
He has left, then how will we have a discussion?
And which reminds me that I have missed a point of the medium and the long run of targeted and actual capacity.
That is what I was going to respond
on.
That is exactly what I wanted to respond on. Anyway, now he's not there, so...
No, but since the question was raised in the audience, so maybe others are also interested to listen to the response.
Please go ahead.
Okay, so let me make my two brief points on this. First, I tried this paper, of course, tried to stay away from that medium run, long run kind of a debate. This is supposed to be a medium run growth model where in any case, the divergence can exist, the actual and the normal. But on the larger question of that, if there is a divergence, what should adjust? Whether the actual capacity utilization rate should adjust to the normal level or the normal capacity utilization rate or the desired level should adjust to the actual. It seems to me that I'm more inclined to take the latter view. There has been a long debate between Peter Scott and Amitabh Krishnadat on this, that what would adjust, and Peter Scott's critique of the normal capacity utilization rate should not adjust. It's like thinking about some optimal level of car speed which in any case exists in the system. So just because some cars have surpassed that speed limit or is going below the speed limit, does not necessarily mean that I would change my position, that what I think about the normal speed limit. It seems to me that when the entire traffic system and the entire population of the place adjusts their normal traffic speed, each individual should also change the expectations, what they believe to be the normal speed of each car as well. In other words, if it is the case that I believe that the normal capacity utilization rate is 80%, and the actual capacity utilization rate happens to be 60% for a long enough time, there exists no priori reason why firms should not adjust what they believe to be the normal capacity utilization rate. And in a new normal, why shouldn't they think that the new normal is 60%? And of course, there exists the additional question that how do we actually think about the long run? Is it simply analytically distinct category other than the short run or medium run? Or is it simply a sequence of short run or medium run one is thinking about the long run as such? Does there exist any long run in abstract is also perhaps a question that needs to be addressed.
Okay. So if there is no other questions or comments, so thank you all. Thanks to the speaker and the panelists for this excellent presentation and also excellent discussion. I think all of us enjoyed this and learned a lot from this discussion about drivers of investment in Indian manufacturing. And I would request you all to stay connected with the ISID, this research seminar, which we usually do twice a month. And any one of you, I would request in some time to present the papers that you have already published or in a process of publication. So thank you once again. Thanks all. So goodbye.